Bruce, are you ready to just dive right in?
Ready to go.
Charlotte has your first question.
Hi there, my name is Charlotte Schwartz in Toronto, and my question is, will the interest rate hike today cause a decline in housing prices in the market? And if so, and presupposing that people can now enter the market who may not have been able to do so before, how will that impact their ability to borrow when they make a purchase?
What do you think, Bruce?
I think house price growth will certainly flatten, and we may well see a decline in some markets. This isn't necessarily a bad thing. I mean, if you're a seller and this was your time to take profit on the home you've owned for decades, you might be a little sad about that. But as Canadians, I think there's a shared value around some semblance of housing affordability. So there may be a flattening in that growth and maybe a decline in some markets. Fingers crossed. In terms of affordability, it is tough. Rates will rise. If house prices pull back a little bit, it's still going to be very hard for a lot of Canadians at the incomes they're earning and the down payments they have saved to buy a home. That is a challenge that has been with us for 5 or 10 years. It's only gotten worse. And I think we can hope that if the growth in these prices flattens out a little bit, that the market will return to some semblance of balance.
Okay, so Bruce, as you can probably imagine, housing is a bit of a preoccupation for Canadians. We've had a lot of questions. A follow-up from Jeff Rankin, who asked, is the Canadian housing market currently in a bubble? And if the interest rates continue to rise over this year, will that bubble pop?
We don't know. No one knows. No one knows. Here's the thing that I would ask Jeff is, why does that matter to you? So if you bought a house 10 years ago and it has doubled in price over that time, if all of a sudden you're right, it is a bubble, it pops, and that house price drops by 30%, it will feel horrible, but you will still be way, way further ahead than when you bought that house a long period of time ago. If you have no intention of selling the house, whether it goes up or down is only a loss or a gain on paper. It doesn't matter. I'm going to stay in my house until they come and cart me out the front door in a box. So whether the price goes up or down doesn't really matter so much to me. It just feels worrying. It's upsetting to see, but doesn't actually affect me financially.
Okay, I hope it doesn't come to that, carting you out of your house in a box. Here's a question.
60 years from now, I'm ready.
Okay, here's a question from Kenneth.
Hi, I'm Kenneth Fung. I'm retired. I'm wondering, with the interest rate hike, when and how am I going to pay back my personal line of credit? Thank you.
Right, it's not just about houses, huh?
And for personal lines of credit, those rates are variable typically, right? And so that is an immediate increase. So for someone who's got a fixed rate mortgage, they may not feel that rate hike for a couple of years when they renew. If you've got a variable rate or a line of credit, you will see that and feel that immediately. His question is, how do I pay that off? Well, it is the same for everyone. And that is, you've got to look at cash flow and see where you can increase income or reduce expenses. For retirees, there's not a lot of retirees who are headed out there and getting another job. They've either made a choice or there is there's some reason why they're not drawing a paycheck like they were before they retired. So that comes down to expenses. And this is the mom and apple pie phrase that no one likes. You have to live within your means. And now we've got this reality that food costs more, gas costs more. If you've got a debt outstanding on a line of credit, that costs more too. And so like the law of gravity, you've got to live within your means and find ways to pull back on expenses such that you're not pushing the balance on that line of credit up even higher.
Well, and you have to imagine folks with, car loans, student loans would be facing a similar sort of situation. Adrienne, you've got another question from Mike.
Yeah, it's a pretty tight one, actually. Mike wants to know, what is a good, safe investment now? The thing is, Bruce, no one's asking you what company people should be investing in, but broadly, are there types of investments people could maybe feel more comfortable with in a high interest scenario?
Well, I love the paradox of that good, safe requirement, right? Because there is a trade-off between risk and reward. The higher the risk, the higher the potential reward. The lower the risk, the lower the potential reward. So as we look out to the future, the other big question to ask yourself is, what am I investing for? Am I investing for something 40 years out into the future, or is it 5 years out into the future? Because what you put your money in is relative to the time in which you need it. Back to basics here. If you're investing, let's say it's for retirement, you want to be diversified across different companies, different sectors, different geographies, and you want those investments to be at a low cost. So that's the mom and apple pie. I am not a fan of flavor of the month. It's a headline grabber. It's super fun. Maybe with 5% of your portfolio, you play with stuff and invest in the flavor of the month, the thing that's exciting. But for most of it, it really should be so boring. Diversified, low cost, boring, just like me.
All right, we have a million more questions. We are not going to ask them tonight. But Bruce Sellery, thank you for joining us this evening.
My pleasure.